There are numerous correlations in the stock market, many of which may not come as quite the surprise. One in particular may hold the key in forecasting the next big trend. We're taking a look at the S&P 500. This is the entire year 2024. We've broken it down by sector on the left-hand side, by each month of the year on the top, by the total cumulative returns for each sector on the right-hand side, and the average returns by month at the bottom. Now, there are some correlations that will come as not that much of a surprise, such as electronic technology and technology services. Electronic technology, very simply, it's the design and development of the tech devices, the components that we use. Technology services, plainly, it's the services, software and cloud products, IT, things of that nature. These are the stocks commonly found in both sectors, and no big surprise, they move together. During down months, in particular, we see April and December. They both experienced negative returns. However, the vast majority of the year, they both moved up very closely together, actually. We also consider finance and consumer services. What do they have in common? Well, the consumer. The consumer uses the big banks on the left hand side, like JP Morgan, Bank of America, and the consumer uses the services produced by or offered by McDonald's, Disney, Starbucks, Airbnb, etc. And we can see here, it's the same correlation, very closely, in fact. In April, both were down, as well as December, and the vast majority of the year, they were both strong. But the correlations, the actual returns, are shockingly quite close. There's a lesson in this, is that when the stock market's going up, the stock is not as important as a sector. Industrial services and distribution services, they're linked. The industrial service sector, that includes maintenance and repair of equipment for the manufacturing sector. Once the goods are produced by the manufacturers, then we look to distribution services like logistics, transportation, inventory management. And these are the components that are typically found in each one of these respective sectors. And the same type of correlations very much hold true in very close degrees. April and December were the worst months. The vast majority of the year, they moved up together. Now, the Magnificent Seven, we can't talk about 2024 without mentioning the big stocks in the Mag 7. And they did perform well. Notice in December alone, they were up 6%, while the rest of the market was pretty much negative. And what we're going to show you in a moment, by the way, there's one correlation that's actually very important to watch when we mention it, that it's going to sound very familiar to you, but it's really going to make the difference, I think, in the year to come in 2025 between strong and weak stocks. Notice, by the way, the total cumulative returns of the Mag 7 here at the bottom, up 51%, far outperforming the rest of the markets. Now, let's take a look at stocks and bonds. Well, here we see our stock grid, and at the bottom, we see the average returns by month. And then at the very bottom, the 10-year Treasury change. Now, the 10-year Treasury change, just to be clear, it's the percentage change, the change of the percentage of the 10-year Treasury bond. If it moves from a 360 to a 363, that's 3 basis points. This is the change the 10-year bond experienced every month of the year. And what you'll notice is a very strong negative correlation. We measured it. It's actually a 70% negative correlation. In other words, when the average stock returns, the cumulative returns for each month go up, the 10-year Treasury yield drops. And there's a very close negative correlation. When the yields rise, and the 10-year bond's been very strong right now, and lately over the past couple months, that typically correlates to weak stocks. Oh, wait a second. We saw lots of strong stocks, but we just saw the Mag 7. Don't let the Mag 7, blind us from the rest of the stock market, which in December was actually quite weak. And that correlated with a very strong 10-year bond yield. So excluding the Magnificent Seven stocks, Amazon, Apple, Nvidia, etc., you take those away, and then you have a very strong correlation, a negative or opposite correlation with a 10-year bond. Well, we can see here how clearly this works out. When one goes up, when the stock market goes up, excluding, of course, a Mag 7, then the 10-year bond treasury yield tends to move down. Speaking of the 10-year bond, this is what it looks like in terms of yield over the past couple months, and it has been quite strong. We've spoken about this. There are numerous job numbers that are expected this week. We're going to watch this very closely because, again, if we see this yield go down, what will that tell us? The expectation, the economy is starting to soften, and maybe the Fed will put a rate cut back on the table. As of right now, the Fed funds futures are telling us the Fed's probably not going to cut rates anytime soon. And that's putting a strain. These high yields are putting a strain on the stock market. Watch the 10-year bond reaction as we get our jobs numbers this week. We hope this has been helpful. We look forward to seeing you back soon.